So let's see. Let's see how far you can go. We can start with the valuation of options. Valuation of options. Valuation of options. Option contracts. Valuation of option contracts. Then we can say two models are available. Two models are available for valuing an option. Two models are available for valuing an option contract, i.e., number one, we have Black-Scholes model, and the second one we have binomial model. So I start with Black-Scholes option valuation model. And with Black-Scholes, we can go to me as well. Sometimes you can get a good examiner, ameleta value to me the Black-Scholes na nakupa the formula. So we can go direct to a question that waliweka formula. I can say a question in page 15. That is April 2022, question 3D. April 2022, question 3D. Hapo kwa April, question 3D. The concept of option does not change. I think we define what an option contract is. That's why I'm not writing a lot of things about it. The option to call, the call option is an option to buy or sell. Nambianga neighbor sema buy, sema sell. The option to buy is call or put. Nasema na confidence. Is the option, the call option is the option to buy, and the put option is the option to sell. Kama kata kunyorosha na make statement. Call option to buy, put option to sell. Sasa. Now let's look at that question. Question 3C, question 3D. Now, question 3C najua unaweza pata kama hujazisoma sasa hivi. By end of this week, I should ask you those questions. Hi, it's page 15. Whoever is asking about the paper. April 2023, right? Question 3D. April 2023, question 3D. Now we are told that the current market price per ordinary share of Kanga Limited is 58. Current market price is the spot price. So the spot price is 58. The price today. The current is about today. Today is the spot. Yeah. So the spot price is 58. A call option exists on the company shares with an exercise price of 52. So you have the exercise price standing for E. Wakati mwingine wanatumia S for strike. Exercise price ni sawa na strike price. Na wamesema exercise price ni ngapi? 52. With 6 months to maturity. So time ni ngapi? 6 months. And in valuation of options, time must always be in years. Time must always be in years. So 6 months becomes 0.5. 0.5 years. Time must always be expressed in years. 3 months, 3/12. That's how. 9 months, 9/12. Time in years. The option can only be exercised on maturity. That is, it is a European option. The risk-free rate of return is 6%. So our RF is 6%. And the variance of the rate of return on the shares is 15%. Variance is the standard deviation squared. Variance is the standard deviation squared, right? Yeah, because square root of variance, we get the standard deviation. Yeah. Then we are told that using Black-Scholes option pricing model, estimate the value of the call option. Estimate the value of the call option. The examiner was generous. Akasema to get the value of the call option, we take spot price times what? So SND1 minus END2. Let me do divide by so that I avoid that your negative. So I divide by exponential of RT. E raised to RT. So exercise price huku wameita K, the strike price. Initial ndio unatumia ni sawa. Cha muhimu ni ujue inamaanisha nini. Hata exam na hapa ameinterpret akasema S is the current value of the underlying asset, K is the strike price. Strike price is on an exercise price, tumetumia hii. Tumia K ni sawa. The variables that use not very much important as long as you are able to interpret them. Then wakasema, so just try to make it a little bit easy. We want to avoid that negative because hapo juu, without putting as a denominator, si hapa inakuwa E raised for negative RT. So you want to avoid that negative. Sometimes in a mess watu sana. So you put it as a denominator. Now, that is the formula of getting the value of the call option. What is important here is not to get the variables of that, the variables of this formula. D1, wamesema to get the D1, we take in S over what? S over E. Kwa wametumia K, which is okay, plus R is the risk-free rate of return times 0.5 times standard deviation squared multiplied by T. Formula tu ndio inakuanga ya kazi hapa. You can do 1 over a half is 0.5. A half is 0.5. Then we divide by standard deviation times square root of T. Just give formulas for example, what happens? Say your answers are, your prayers have not been answered. Ukishapata the D1, D2 now becomes more direct, becomes D1 minus the denominator of D1, standard deviation times square root of time. Now let's try answering the question now. Let's get our D1. We have in, leo ndo tunajifunza kutumia in kwa calculator. What is the spot price is 58. 58. Do you have the exercise price? The exercise price of 52 plus we have the risk-free rate of return 0.06 plus 0.5. Do you have variance? Our variance ni ngapi? 0.15. And what is our time? Time is 0.5. And everything we divide by. Come on to make the variance, how do we get the standard deviation? So can you say square root of 0.15 times square root of time 10 is 0.5. Now let's make good use of our calculators. Ndio kama uko na ile strong calculator haina in. Tell me what about say in. Onekana sio. So in tumeiona iko on the right sio. On the right side of the calculator, I think button ya 3 kwenda chini. Chini ya hiyo in kuna exponential kama andikwa in yellow, exponential raised power x. Chini yake we'll also need it because tunataka the exponential somewhere there, but you start with in. Now after you press in, make sure, by the way, finya tu vile iko penye kuna bracket fungua, penye bracket imefungwa funga. So in, open the brackets 58 over 52, close the brackets, plus open the brackets vile iko tu. Hope those in the other room are able to see in, so hauna neighbor. As long as you don't get syntax error, the answer is correct. And it doesn't look ambiguous. So malizana na numerator, you get the answer for the numerator. In, open the brackets 58 over 52, close the brackets, plus open the bracket 0.06 plus 0.5 times 0.15, close times 0.5. Get the answer for the numerator, then divide by weka iko brackets. You divide by, open the bracket, square root of 0.15 and square root of 0.5, close the brackets. Syntax error. Leo sikia kupelekana polepole. Naona 0.645 online. I'm just giving a feedback. Umepata answer, una doubts? Error. What do we have? What do we have? Confirm 0.645. Everything and this come and fair numerator. Inaleta error. Na ikileta error by the way cancel. Ikileta error me cancel. You do this. Na pinya hii anyway hapa. Tapeleka kwenye error hii. Sasa nitalipa. So do times 0.5. when you're using the calc, mambo tuzindane. Alafu ndo imeleta syntax errors. Kuna kaka replay. Aka kameandikwa replay. Finya popote hapa ama huku itakupeleka kwenye error. Incorrect. So that you don't start afresh. What do you have? 0.645. You need the whole thing. That's why I'm here. So 0.645 confirm. So ile siku umesahau calculator na tunafanya za calculate. Ukipata D1, D2 si shida. So D2 equals to D1, which is 0.645 minus the denominator, square root of 0.15 times square root of 0.5. So make sure E equal brackets. So what is our D2? Zero point 0.371. So 0.371. Now, we need to get the ND1. So ND1 and ND2 stands for normal distribution. Normal distribution of D1 and D2. Kwa hiyo settings tuko na normal distribution tables. Normal distribution table ambia neighbor nile table ya mountain. Ile table ya mountain. And under the black and scrolls, when you're dealing with the normal distribution table, you're looking for the ND1 and ND2. D1 equal positive. Then, when interpreting this mountain, when it is a positive, then it is on the right side. Then it means it is 0.5 plus whatever we get. If D1 and D2 equal positive, then they are more than 0.5. So if you are negative, then it is 0.5 minus what you read in the table. If it's a positive, it is 0.5 plus. If it's a negative, it is 0.5 minus. So if it's a positive, then it is 0.5 plus. Then it means this is our area. In case of a positive, D1 or D2. If D1 or D2 is a negative, then it means we are looking for our area, which is 0.5 in a coincident. 0.5 minus. So 0.5 minus whatever we read in the table. So this is the area. So if you are negative, the less than 0.5. If you are positive, the more than 0.5. Fortunately, our D1 and D2 is not any positive. So can we read in those tables? We only need 2 decimal places when you're reading in the normal distribution table. Like now the ND1, our ND1, normal distribution of D1 equals to, when you check in that table, is 0.65. 0.65 is 0.2422. But because it's a positive, it's 0.5 plus 0.2422. So that one becomes 0.74. 7.422. Ikiwa ni positive, hakikisha your D1 and D1 is more than 0.5. Sawa. What of ND2? Right now kuna neighbor bado na struggle kusoma hizo tables. Pia ni positive. So 0.5 plus what is 0.37? The normal distribution. 0.14. 0.1443, sindio? That becomes 0.6443. Right? So you can now get our BC. So therefore, value of the call option equals to the spot price. Spot price ni ngapi? 58 times normal distribution of D1 0.7422 and D1 minus the exercise price of 52 times ND2 of 0.6443. Divide this by the exponential. What is the risk-free rate of return? So 0.06 and the time was 0.5, right? Exponential raised for RT. R is the risk-free rate of return, T is time. So again, tuanze na hii. In our calculators, are you able to see the exponential factor? Kama uliona hii, huwezi kosa kuona exponential. Iko either in yellow ama in red. Yo kanengine ndoka red. So anything in yellow you start with shift. I prefer we use the yellow one because yellow already shafanya e raised for x, the yellow one. Anything in yellow so start with shift. Any function in yellow, so kindly shift then in. Shift in, open the brackets, weka in 0.06 times 0.5, close the brackets. So shift in, kindly, open the brackets, don't trace. Kufanya shift in, ukiangalia hiyo iko in yellow, already imesema exponential raised for x. So it's already raised. So simply shift in, then open the bracket 0.06 times 0.5, close the brackets, you have your answer. Then bila kuguza popote, fanya 52 times 0.6443 divided by answer. Mamdani na huku mbele. 52 times 0.6443 divided by answer. Then after that, the final step, 58 times 0.7422 minus answer. We have the value of the call option of how much? Sorry? 10.53. That is what was expected of us, of them. For how many marks? For 6 marks. Which one is 6 marks? Now, let's go to May 2016, question 1B. May 2016, question 1B. What are page numbers? Page 79. Yani hapa I have kwa formula ni I have. Ndio kwa formula wamesema wamefanya hivi. Formula wameandika hivi, standard deviation over 2. So since one kusema 1 over 2 times the standard deviation, 1 over 2 is 0.5, right? The I have it. May 2016, question 1B. So okay now. So May 2016, question 1B. Great. Let's go there basi tushughulike na hiyo. Now, Planet Limited, page 79. Uko nyuma kabisa. Planet Limited is considering undertaking a 20-year project which requires an initial investment of 250 million. Page 79. So the invoice 250 million in a real estate partnership and whose present value of expected cash flows is 254 million. So present value of cash inflows 254, initial outlay 250. That means that project has an NPV of how much? 4 million. 254 minus 250, senior. Planet has the option to abandon the project anytime in the next 5 years for 150 million. The variance in the present value of the cash flows is 0.09 and the 5-year risk-free rate is 7%. Now, when you abandon, are you buying or you are selling? So you abandon una scrapping off is selling. So for 10 marks, the NPV of the project, including the option to abandon the project. Then comment on the result of your answer and your analysis in B1 above. Now, where do you start from in this question? The examiner was generous. Na akapeana tena formula the Black-Scholes option pricing model. Sasa, na akasema the call option, sees about the call option. So value of the call option wakatumia PA ND1. Na uzuri pale chini, fortunately this time wajatudefinia PA ni nini. We just need to know PA is like the current market price, SND1 minus the E ND2 divided by the exponential raised to power RT. Now, let's just say this. Let's just say this in answering this question. Let's just say this since in answering the question we say the option to abandon involves a sell. The option to abandon involves a sell. Hence, it is a put option. Hence, it is a put option. Then you say, value of put option value of put option into brackets PP equals to value of call option plus exercise price over the exponential of RT, then minus the spot price. But the formula pia tumepewa hapo chini. Umesoma put parity relationship. Examiner just being notorious. Siangesema tu that is the value of the put option. But kusema put parity relationship. So that is the value of the call option plus the exercise price divided by the ERT. I'm avoiding that negative. That's why I'm doing divided by. Otherwise, there's a E times exponential raised negative RT. Still okay. As long as we do a calculator vizuri, I'll get my answer. So minus the spot price. Now, by all means, lazima nitafute the VC. You remember the formula of VC? Let us get it up about SND1 minus what? The END2 divided by what? Exponential raised for RT. Can I have my D1? D1 equals to mean spot price over exercise price, right? We add the risk-free rate of return plus 0.5 times variance times what? Times T. And everything we divide by standard deviation times what? Square root of time. So let's now interpret our question. The spot price tuangalie. Planet Limited, now let's go through it again. Planet Limited is considering undertaking a 20-year project which requires an initial investment of 250. Initial investment of 250. This is the price today. The spot price is the value today. Still. So our spot price becomes how much? 200 and what? Avoid the millions, avoid the ends. Our final answer will be millions. So our spot price, the price today, the value of that investment today in year 0 is 250. Right? In a real estate partnership, and whose present value of expected cash flows is 254. Tutasaidia kwa NPV. Planet Limited has the option to abandon the project anytime in the next 5 years for shillings 150. That's on our exercise price. Our strike price. Exercise price ni ngapi? 100 and what? 150. What is our time? I think 5 years. What is our RF? 7%. That is 0.07. Do you have the standard deviation of the variance? The variance in the present value of the cash flows is 0.09. So is that standard deviation square? 0.09. So can we get our D1? So D1 equals to in spot price of 250, exercise price of 150, plus the risk-free rate of 0.07 plus a half. Do you have the variance? 0.09, and time is what? Time is 5. It's already in years. we divide by the standard deviation, the square root of 0.09 times square root of time. Pinya kwa calco upate D1. So in open brackets, just the way it is. D1 becomes long as it's not syntax error. Na ukipata syntax error tumekuonyesha vile unafanya. 1.62. So 1.62. Neighbor napata 1.2. Syntax error bado. This time it's okay. This one is confirmed. Majority have their way, right? D2 nayo. D1 minus its denominator. Standard deviation times square root of time. So you're having 1.62 minus square root of 0.09 times square root of 5. So D2 becomes how much? 0.948. So I can do 95 because I need two decimal places. Can we have our ND1? It's again positive, so it has to be more than 0.5. So ND1, does the setting have the normal distribution table? I made the exempt one. Iko nayo. So ND1, 0.5 plus. What is 1.62? 0.44. So 0.4474. So that becomes 0.9474, right? ND2 it's also a positive, so 0.5 plus is 0.95 in the normal distribution table. 0.328, 0.3289. So this becomes 0.8289. So can we have our BC? So we are having in the spot price is 250. Exercise price is 150. Then we do plus, we have the risk-free rate of return. 0.07 plus a half times, do you have the variance? Oh, tumerudi kwa D1. Alimanza mapema. Haya, BC basi, sorry. SND1 minus END2, sindio? S ni ngapi? 250. What is our ND1? 9474 minus the END2 in 150 times ND2 of 0.8289. We divide by the exponential raised to, what is our R? 0.07. So 0.07 na time ni ngapi? Time ni 5. So we start with the exponential again, it becomes easier. Ukienda direct, by the way, avoid the rounding of errors. Baada ya kufanya moja uweke chini, ndio tena utaanza kusubtract. You avoid the rounding of errors, you get the exact answer. So exponential is shift in, right? So shift in, open the bracket, 0.07 times 5, close the bracket, get your answer. Then 150 times 0.8289 divided by answer. Then you conclude it to 50 times 0.9474 minus your answer. We have our BC. $149.23. It's in millions, of course. It's in millions. So can we have our BP? It was an option to sell, not to buy. We were abandoning. So ufiki kwa VC alafu utulie. BP equals to the VC minus the exercise price divided by that denominator. So our VC is 149.23 plus exercise price of 150 divided by the E raised to 0.07 times 5. Then we subtract the spot price of how much? 250. Just as always, I prefer answer an exponential. Answer an exponential kumaliza na hii. So shift in, open the bracket 0.07 times 5. Close the brackets, get your answer. Then 150 divided by answer. So that I can do 149.23 plus answer minus 250. Anything that is not syntax error? 4 points. Mbona mnajishuku? Positive, negative. It's okay. So 4.93. Now, in answering this question, they wanted us to get the NPV, including the option to abandon. So you just needed to get the NPV of the project, alafu tuongeze the value of the put option. Sasa, so just say hapo chini, the total NPV equals to the present value of cash inflows minus the initial outlay. Then we add the value of the put option. So the present value of cash inflows present value of cash inflows minus initial outlay. That is our NPV. So formula NPV. Then you add the VP, value of the put option. PVCI minus IO. Then plus the VP. What is our PVCI? It was 254. So 254 initial outlay is 250. Then we add 4.93. 8.93. And the positive. For example, mnani wangepata hiyo. Sidanganyane. Hi. Then you are required to comment. Comment ni nini sasa? So accept the project. So just make a comment, neighbor. The project should be, the project is viable. The project is viable with an option to abandon. The project is viable with an option to abandon. Now, the binomial option, binomial, it's not in our syllabus, but test. If we get some time, we can deal with the binomial. That's how. If we don't get some time, I can do a clip still. And do a clip so that I share. Now we talk about the next part was arbitrage. International arbitrage, right? Yeah. So let's say something on international arbitrage. So for the arbitrage, we have 3 types of arbitrage. We have the locational arbitrage, common interest arbitrage, and the triangular arbitrage. So maybe under that, just start with the locational arbitrage. And just a statement before we dig deeper into it, so that we understand what arbitrage is all about. So just say arbitrage involves the steps taken by an investor, aimed at earning a riskless profit, known as arbitrage profit. Aimed at earning a riskless profit known as arbitrage profit. So then you say, under locational arbitrage, the investor takes advantage of different exchange rates. Within the country by buying foreign currency, in a given forex bureau, by buying foreign currency in a given forex, kama jina bureau inakataa sema tu forex, cheaply and selling the same amount and selling the same currency and selling the same currency in another forex and selling the same currency in another forex at a higher price, at a higher exchange rate. At a higher exchange rate. Next point you say, it can only be applicable. It can only be applicable when the two forex have different buying price. Have different buying price. Let's check the past paper. This one was tested. So the August 2023 question 2C. Now, James Kamau had 3.6 million Kenya shillings to invest and is considering the forex exchange market, that is the forex market. The following information relates the two forex bureaus. Kuna foreign forex bureau X na forex Y. Bid price is the same as the buying price. Then ask price is the same as the selling price. That's how. Bid price is the buying price. Fortunately, examiner alikuwa generous. Kusema ni bid stroke buy. So that interpretation is ikuangushe. So bid ni sawa na kubuy, ask ni sawa na kusell. So bid price is the buying price, ask price is the selling price. So in forex X, tunabuy na 0.04 and that is Tanzania shilling spot. Is it Kenya shilling per Tanzania shilling? The 0.08 is Kenya shillings for every 1 TZ shillings. So the amount is in Kenya shillings for each Tanzania shilling, right? Theory English. The amount is stated in which currency? Huh? Not any cash. But it is stated in which currency? In Kenya shilling. The 0.08, is it Kenya shillings or Tanzania shilling? 0.08 is Kenya shillings. Just the same way 0.09 is Kenya shillings. So the exchange rate is 1 Tanzania shilling for 0.08 Kenya shillings. That is buying, and we sell at 1 Tanzania shilling for 0.09 Kenya shillings. That is in X. In Y, 1 Tanzania shillings for 0.1 Kenya shillings buying, and 1 Tanzania shilling for 0.11 Kenya shillings selling. Then the two forex are in the same location. Calculate the locational arbitrage gain for James Kamau with 3.6 million Kenya shillings to invest, if any. Now, from what we are saying, tumesema kuwa ako na Kenya shillings 3.6 million. He has to choose between Forex X and Forex Y. Lazima anunue the foreign currency in one bureau na aende auze in another bureau. You always buy low and you sell high. Now between X and Y, stanunua in X. And there's always a catch. When I'm buying in a given Forex, that Forex is selling. The bureau is selling to me. I'm not, when I'm selling, then it will be the one to buy. When I'm buying, it is selling to me. So let's just make this statement. James will buy Tanzania shillings. James will buy equivalent Tanzania shillings in Forex X. And invest stroke sell in Forex Y. Full stop. Then you say when the investor is buying, comma, the Forex is selling. When the investor is buying, the Forex is selling. Hence, we use the ask price. We use the ask stroke sell price. And vice versa. We use the ask stroke sell price and vice versa. So can we get the equivalent Tanzania shillings at an exchange rate of ngapi? 0.08 or 09? The Forex is selling. That's where we are buying. Sitatuzia. We are the ones buying. And when we are buying, somebody is selling to us. So that person, the exchange rates are not for us. They belong to the bureau. The exchange rates belong to the bureau. So if we go to buy, they're the ones selling to us. That's how. When we go to sell, they are going to buy from us. So tutumia ile exchange rate ya B ama ya kubuy. Lakini tukinunua au wanatuzia, we use the selling price. So 1 Tanzania shilling equals to 0.09 Kenya shillings. How much Tanzania shillings are you going to get from the 3.6 million? So we are having shillings 0.09 for 1 Tanzania shilling. Out of how much Kenya shillings? About Menyoroshwa. So 1 Tanzania shilling for every shillings, Kenya shillings 0.09. Out of Kenya shillings 3.6 million. So Tanzania shillings ngapi? How much? 40 million. 40 million. That's the first step. Then the next step, we look at the equivalent Kenya shillings in Forex Y. So equivalent Kenya shillings now in Forex Y. So nunua Tanzania shillings at a lower price and go and sell them. Ukienda kuziuza kwenye bureau nyingine, now you get back your Kenya shillings. So do you have the exchange rate? Now we are selling. When you are selling, the bureau is buying from us at an exchange rate of 0.09. 0.1. So this time round, we have the Tanzania shillings, we need the Kenya shillings. So this one becomes really long cut. If 1 Tanzania shilling equals to that, what about the Tanzania shillings 40 million? Do we multiply or we add? We multiply here. So 1 Tanzania shilling for every it is Kenya shillings 0.1 for 1 Tanzania shilling out of Tanzania shillings 40 million. So I having Kenya shillings 4 million. So before I decided to engage in that transaction, how much did I have? 3.6. After that, fanya hiyo ukora, napata ngapi? 4 million. What is the arbitrage profit? Unapata 4 marks. 1. So therefore, arbitrage profit equals to 4 million minus 3.6. So 400,000. There are people who do this, by the way, for a living. Wanajua exchange rates are different bonus in Nairobi. Anapeleka pesa zake dola na Kenya shillings, anaenda exchange huko, ananunua the dollars, anaenda huko kwingine ananunua the Kenya shilling. He makes money out of it. That it's happening. It's happening. Now, for another 2 marks, the scenario that is necessary for locational arbitrage to exist. The bureaus must have different exchange rates. The bureaus must have different exchange rates. So for the locational arbitrage medium, ask big price. You go and invest where it is cheap. You buy the foreign currency at a cheaper price. But remember, when you are buying, the bureau is selling to you. So natumia the ile ya kusell. Ukienda kusell, that bureau is now buying from you. So to eat, inatumia the buying price, bid and ask. So examiner neza mwata azichanganya aje. Wewe angalia, the first option I want to sell. I want where the bureau is selling to me because I want to buy. Look at the 2 forex. Now angalia ile yenye kuna the lowest price for selling. Anza na hiyo. Alafu naenda na hiyo nyingine. Just checking around with the two forex bureaus. Hiyo arbitrage nyingine ilikuwa gani? Covered interest, right? So covered interest arbitrage. So here locational arbitrage, covered interest arbitrage, and triangular arbitrage. Let's see what happens in covered interest arbitrage. So for covered interest, we say it is applied where an investor intends to consider investing in 2 different countries. investing in 2 different countries. So locational is about, we can be talking about the same term. You're looking at the different banks, different forex bureaus, covered interest about different countries. Put full stop, then you say, next point. The investor invests in a country that offers a higher interest rate. In a country that offers a higher interest rate. And compares the resultant outcome with the investment in the alternative country. For determining arbitrage profits. I think it was also tested. November 2020. The blue paper question 2. Question 2C. November 2020, question 2C. Naona part A nauliza about the IRP, the interest rate parity. So I don't know if we should mention about the parity. Tukuje tujibu hata hiyo pia tusiache. Just write for me the parity which is triangulars, just how. Because I can see that question, but one is asking about the interest rate parity. So kindly, just parity measures. I know you'll not confuse. Parity measures. Let me say, they are used to determine the point of equilibrium. They are used to determine the point of equilibrium between the forward exchange rate, the point of equilibrium between the forward exchange rate and the spot exchange rate with regard to the interest and inflation rates. In both foreign and home countries. With regard to interest and inflation rates in both foreign and home countries. So we start with the IRP. IRP stands for So interest rate parity. IRP. Then you say it uses the interest rates. It uses the interest rate differentials. It uses the interest rate differentials in home and foreign currency, in home and foreign countries. Interest rate differentials in home and foreign countries, i.e., under IRP, comma, at the point of equilibrium, point of equilibrium is on a point of indifference. Naweka full stops mbili, then you say the forward rate equals to, so F equals to S times 1 plus interest rate in home over 1 plus interest rate in foreign. 1 plus RH over 1 plus RF. RF series free, by the way. So F equals to forward rate, and S is what? Spot rate. And of course, RH and RF is the interest rate. Interest rate in home and foreign countries, respectively. And let me explain something here. Under the parity measures, examiner atakupa, you see the variables are 4. Here, tuko na F, tuko na S, tuko na RH na RF. Examiner will give you 3 of them, alafu atako calculate 1. He can give you this, alafu akuulize, determine the interest rate in foreign country. He can give you this and the 2, atake calculate the spot rate. He can play around with whatever, with you, in whatever way that he wants. As long as it is interest rate parity, angalia ni nini umepewa, ikusaidia kupata chenye examiner anataka. Sawa. Then number B, triple P, purchasing power parity. Purchasing power parity. Then we say it is similar to IRP. It is similar to IRP. Except that PPP uses inflation rates. And not interest rates. I.e., at equilibrium, F equals S times 1 plus, we can call it IH, divided by 1 plus IF. Kila kitu ni the same. Tofauti ni kuwa huko tunatumia the interest rate, huko tunatumia inflation. So IH and IF is the inflation rates in home and foreign countries. So IH and IF equals inflation rates in home and foreign countries. And finally, number C, international Fisher's effect. International Fisher's effect. We say it is identical. It is identical to PPP. It is identical to PPP, except that the Fisher's effect, the Fisher's effect considers the change in the inflation rates. The change in the inflation rates at home and foreign countries, respectively. The change in the inflation rates at home and foreign countries, respectively. So this one, formula ni the same by the way. Tofauti ni kuwa, hapa tutakuwa tumepewa inflation rate moja peke yake, but under the Fishers, tutakuwa tumepewa the two inflation rates at home and two inflation rates in the foreign country. Just get the difference. What is the change in the inflation rates? So just repeat this formula. Just repeat the formula for triple P. So you can just say IE, F equals to S times 1 plus IH divided by 1 plus IF. So IH equals to change in inflation rates. Inflation rates in home country. Then IF is the change in inflation rates in foreign country. Now let's check this question. Let's check this question out. Let's check out this question. Page 40, question 2C of December 2020. Let's check the exact blue or green. Now, you have recently been hired as a financial manager at Funblock Limited, a locally incorporated company that deals in imported building materials from United States of America. As the person in charge of negotiating the exchange rates, you have noted the following indicative exchange rates and interest rates. So as you are going through the question, you should be able to know home ni wapi, foreign ni wapi. Home ni wapi? Foreign tumepewa. Kwanza tukiangalia kwa exchange rates kuna Kenya shillings na USD. So by all means home ni Kenya, sio? Alafu foreign inakuwa wapi? US. So you have the 3 months forward exchange rates and you have the spot exchange rates. 3 months interest rates in Kenya and the 3 months interest rate in USA. 8% and 5.8% per annum. Assume that Funblock Limited can borrow as much as Kenya shillings 1 million. For the first 2 marks, determine whether the interest parity is currently holding. Is IRP currently holding? What if you just say no? You get 1 mark, right? It's question 2C of November 2020. Question 2C of November 2020. Now, what the examiner is asking is IRP way. So, in answering part 1, we know that under IRP, the forward rate, but then it can be forward rate, the forward rate equals to the spot rate times 1 plus the interest rate at home, divided by 1 plus the interest rate where? In foreign. Now, this is what the examiner wants you to do. Assuming, for you to make what the foreign exchange rate, you have the 3 months foreign exchange rate of 105. Clear? So assuming how you have the spot rate, you have the interest rate. Can you confirm if you get 105? If your answer will be 105, then IRP is holding. If your answer is not 105, then of course IRP, there is no equilibrium. See the formula part of the equilibrium. So for the IRP to be holding, our forward exchange rate should be the same as the spot rate as a multiple of this. We have the spot rate of how much? 100. We have the interest rate at home of ngapi? I think 8%. But careful, how many months? Be very careful. Time is of essence. So 8 times 3 over 12. You're not mandika. Which gives us 2%. So that is 0.02. Clear? Do you have the interest rate in foreign country? 5.8 times what? 3 over 12. Which would be? So 1 point, 4 times 100. 1.45. So this is 0.0145. So therefore, 100. So the forward rate should be equal to 100 times 1 plus 0.02 divided by 1 plus 0.0145. Confirm what you get. So 100 times 1.02 divided by 1.0145. You get how much? How much? You quit as long as this is together. 100.5. So is IRP only? If you do an so IRP is not holding. Why is it not holding? Because background, the forward rate is 105. So there is no equilibrium. IRP is not holding. So, sir, since in reality the forward rate is 105. Now our interest was in part B, part 2, demonstrate how you could undertake a covered interest arbitrage, assuming the IRP is not holding. Of course, it's not holding, it's not even an assumption. Now, let's interpret it now. Before to we have 1 million Kenya shillings to invest. Ndio. Na hii mambo ya arbitrage, ile concept kwa tunasema don't put your money in the bank. Take your money so that you can transact and get something out of it. That's why for location, hiyo pesa si ati niliomba. I had the money in the bank account. Now I transact. I go and buy some foreign currency. Then I exchange. I take it. I go back to my original currency so that I can make profit out of it. So even in this case, you have 1 million. We're asking ourselves, should we invest in Kenya or should we go invest in US? When I invest in Kenya, what is the interest rate in Kenya? Interest rate in Kenya is 8%. And what is the interest rate in USA? 5.8%. Now, what is the best place to invest? I invest where I'll get more. I invest where I'll get more. And I'm going to get more. The 3 months interest rate in Kenya is 8%. The 3 months interest rate in USA is 5.8%. So because it is more profitable to invest in Kenya for the 3 months. That's how. Then una compare, una compare pia, what if I had gone to invest in USA? What would I have gotten? Alafu una find out which way to go. Ile profit utapata itakuwa ya ngapi? So let's see. So you can just say this. Since Kenya offers a higher interest rate, since Kenya offers a higher interest rate, Fund Block Limited should invest in Kenya. Should invest in Kenya for the 3 months. So the future value would be how much? Now you're investing, you're looking at the future, not looking at the present. So we are having 1 million Kenya shillings, which will require interest rates for the 3 months already. That's 0.02. So 1 plus 0.02. How much will I get? $10.20. $20,000. Sindio? Alafu unajiuliza if investment was in US, kama angeamua kuinvest kwa USA, in USA, if you want to invest in USA, first of all, you have to change the currency. Uko na Kenya shillings, pata the US dollars now. So the equivalent dollars at spot rate. We have the spot rate. Shillings 100 per dollar. So 100 shillings gives us $1 today. How much dollars shall we get from the 1 million? So $1 for shillings 100 out of shillings 1 million. You're having how much of the dollars? The 10,000 or what? $10,000. For you to invest in USA, you invest the dollars. In Kenya, you invest the Kenya shillings. So what will be the future value in USA? I'm having $10,000. The interest rate here, what we have 0.0145. So 1 plus 0.0145. How much will I have there? Ten? 1014. Huh? 1014.5. So can we have the equivalent? Equivalent Kenya shillings. Do you use the spot rate or the forward rate now?
Forward.
We now use the forward rate. Ndio. Kwa sawa? Kompyuta inasema ngapi?
10,
Huh?
145.
Is it 10,145? So equivalent Kenya shillings. We use the forward rate or the spot rate? The 10,145 is the amount after 3 months. We can only get the equivalent using the forward rates here. So the equivalent Kenya shillings at forward rates, at 3 months forward rates. Of shillings ngapi? 105. So we are having $1, sorry, shillings 105 for $1 out of $10,145. How much of the Kenya shillings shall we have? Ten? 1065,225. So it's a matter of comparison. And you advise, should you invest in Kenya or should you invest in US? They invest in US. So advice would be so therefore investment should be done in USA. It's more profitable. Investment should be done in USA. And that is the 4 marks. The last 1 mark, I want you to get the arbitrage profit. How much profit do you get by investing in USA instead of Kenya? The difference here. So 1065,225 minus 1020. Now, hata kama tumebit, tunaona tumebit. Triangular arbitrage method for recording. But I just want us to, there's some things that when they test, when the examiner brings them, haufai kuanguka. And let me just take you through them a little bit. Still in the same November 2020, look at question 1B. Wakati mwingine unapewa swali na unapewa formula ya kupata answer. That's how sometimes examiner is generous for those people who have courage, like you. For those people who are courageous the way you are. So you look at that question 1B. Allow me just to go through it. Professor Edward Altman's, that is the predicting corporate failure. Predicting corporate failure, you have different models. Altman's Z-score, you have the Zeta model, you have the financial ratios. Na just go for notes. Hivyo umezipigia. Ile page utafika hiyo. Utaipigia. Sure umepigia before next week. Now, so models ziko na formula. Na amesema ya Z-score, Altman's model for predicting of bankruptcy is given as follows. Z-score equals to 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 0.99x5. Na wamepewa na formula x1 wamesema equals to net working capital over what? The total assets. Kwa ile knowledge ya baby class, unakumbuka working capital? Working capital is current assets minus current liabilities. So, the net working capital, so meaning to get our x1, net working capital per balance sheet, are you able to see our net working capital? Current assets ni ngapi hapo kwa balance sheet? Missing 100,000. And the current liabilities? Are you able to see 20? So that is our working capital. We divide by what? We divide by the total assets. Are we able to see our total assets in the balance sheet? Of how much? 400,000. What is our x1? 80 divided by 400, 0.2. Alafu x2, wakatuambia x2 equals to retained earnings over the total assets. And by the way, it's always the retained earnings as per the balance sheet, not income statement. Retained earnings, your balance sheet. How much is our retained earnings in the balance sheet? I think 120,000. So retained earnings of 120,000. We divide by what? The total assets. Ambazo ni ngapi bado? 400,000. X2 iko ngapi? 0.3. So retained earnings is a balance sheet, the retained earnings, the income statement, sorry. Then X3, wakasema it is the operating profit over total assets. Do you have the operating profit? Hiyo inapanga kwa income statement. Operating profit yetu ni ngapi? 40,000. We divide by the total assets of how much? 400,000. This is 0.01. 0.1. 0.1. We have X4. X4 kasema is the market value of equity shares divided by the book value of debt, including the preferred shares. We have the market value of equity. The market price per share times the number of shares. What is the market price per share? For additional information, missing 15. How many shares do we have? 100,000 divided by 10. Are we saying 10,000? So times 100K divided by 10. That gives us the market value of equity, right? Then we divide by the total liabilities, including the preferred shares. We have the total liabilities. Madeni yote. Current liabilities ni ngapi? Current liabilities ni 20. Preferred share capital ni ngapi?
40.
And the 10% debentures?
8.
So total is how much? Nipata kusema 400.
140.
Total liabilities including the preferred shares. So that gives us 1.07. Finally, X5. Wakasema X5 equals to sales over total assets. Do we have sales? 400,000. The total assets negative. 400,000. So this one is 1. And after that, wakasema going to get the Z. Unachukua 1.2 times x1. So 1.2 times x1, which is 0.2. Right? Plus 1.4 times x2. So 1.4 x2 is 0.3. Plus, I think 3.3 times x3. 3.3 times x3 of 0.1. Then plus 0.6 times x4, x4 1.07. And finally, 0.99 times x5. 0.99 times what? Times 1. Ukifinya kwa calc, what is your Z? Two point six three. 2.631. Nimeona swali kwa mtandao kuhusu shall revisit. So 2.631. That is the 5 marks. Then again examiner kwa hii sitting alikuwa very generous, akakupata how to interpret. Na akasema for interpretation, and it's always that way by the way. For interpretation, hata hapo tumepewa tuko na 1.8 na tuko na 2.7. Let's just go through that part. In this model, Z score of 2.7 or more indicates no signs of failure. And Z score of 1.8 or less indicates the signs of failure. So if for 1.8 or less, ikija huku, then there are high signs of failure. Ikiwa 2.7 and above, low signs of what? Low signs of failure. the no signs of failure. And of course, if it is more than 1.8 but less than 2.7, hapa kwa tunasema the company is in a safe position. So is the company safe or it has high chances of failure? The company is safe, sindio? So comment on the results obtained in B1 above. The company is in a safe position. I think they brought a similar question in December 2022. If I'm not wrong. December 2022. No, it's page 20, question 3C of December 2021. Sorry. December 2021, question 3C. Someone is saying Springate model. Usiogope majina. Just interpret the question. You've been given the formula. Apply the formula. But there's sometimes kitambo walileta swali ya Z-score na hawakupeana formula. Hii inakuwa na error. Now, somebody is asking here online that the December 2022 senior question 3B, pilot paper, the genuine paper. Now, somebody is asking that we're supposed to compare the 1065-225 with 1 million instead of 1020. Now, I was looking at the two options, and I'm looking at somebody who invests in Kenya and somebody who invests in USA. How much more do I gain by investing in Kenya? How much more do I gain by investing in USA compared to investing in Kenya? So not looking at don't invest or invest. We are looking at should I invest in Kenya or should I invest in USA? It's all about the additional benefit that I get by investing in this country and not in the other country. And that's why we don't compare the 1 million, we compare the 1020. And I think with that one we can we do some parting shots? Ama kuna swali burning? Huh? You have to apply these formulas, imagine. Hazibadilika in hizi. So sijui kama hizo utaandika mahali kwa mkono. Basi hizo hatuendi na mask. Kama utaenda na mask. The Z-score formulas ni hizo tu. So to be safe, just try. Kama unaweza memorize, useme kwa kila alisema uandike mahali. No, ukienda ukaniandika huko. I think somebody has seen it in pilot paper. Pilot paper ya huko nyuma kabisa. Pilot paper mezani hapo. Anyway, kuna time wapeani formulas washindwe.